Hey guys, Shannon and Michael here with Healthcare Genius. We're here today to walk through your personalized report on the punch in the gut tax from Social Security. So if you have your report and you've looked through it and you don't really know what to do next, or you don't know exactly what it's saying, that's why we're here.
Yeah, and Shannon, we spent a lot of time over the years trying to put together something that would help people understand healthcare costs in retirement. It's probably the biggest question we get. It's actually just not us, but MetLife does a study every year of employee benefits. It's the biggest concern that most people who are thinking about retirement have is, what are my healthcare costs going to be, and can I afford it? So this report's designed to help you understand what those forecast costs are, as well as it's going to actually show you how that will impact your Social Security, because believe it or not, these costs come right out of your Social Security check when you retire.
That's right. So if you have not yet gotten your report, you can go down to the description below, click the link. It'll ask you some questions about yourself, and we'll use all of those things to provide you with your personalized report. Now, the first thing that we want to look at when we're looking at healthcare and retirement is IRMA, Income-Related Monthly Adjusted Amount. And the reason we want to look at that is because, believe it or not, Medicare is not only not free, but it doesn't cost the same for everyone. The more you make in retirement, the more you'll have to pay for Medicare Parts B and D.
Yeah, Shannon, let's kind of look at the history of, we like to call this means testing, or Medicare means testing. Again, IRMA is the official name. The best name is the punch in the gut tax, which came from one of our clients. But historically, Medicare has been a pay-as-you-go program, meaning there aren't a lot of dollars in a trust fund to pay for Medicare Part B premiums and Part D premiums. The government basically calculates those premiums every year, and then the persons who are retired, who are making less than $85,000 as a single or $170,000 as a couple, they pay 25% of that premium that Medicare determines. That's traditionally what's happened. Well, Medicare's looking at the baby boomers going through, or the federal government's looking at the baby boomers going through, and they're saying, we're not going to have enough money. So back in 2003, they passed a bill that allowed for means testing of Medicare. It did take effect in 2007. One of the reasons that you look at Medicare Part B and get concerned, or at least we do for our clients, is that those premiums have increased at over 7.5% a year annually, compounded. So when Medicare started in 1966, it was $3. It's $135.50 today. So that's really when we begin to look at this and let our clients know that you need to be thinking about how you can plan appropriately for it. So that's a little bit of the history of it. It is expensive. It's going to continue to get more expensive as more people come under the Medicare system.
So it's essentially the Social Security's answer to how do we pay for the sheer amount of people that are going on Medicare.
Since 2007, things have changed quite a bit. If you look at the thresholds, 214,000 was the highest. A couple of years ago. It's now 160, with the exception of a bracket that was added in 2018 for $500,000. But when you look at that, those individuals who are making over 160,000 are paying 80% of that premium, not 25. So that gives you a little bit of an idea of what those costs actually are. And the chart in the blue area, we basically show what somebody who's making under 85,000 would be paying versus the person who's making over 160. So it's more than double, triple actually in some cases, for those premiums.
If you'll remember, when you filled out the quiz, you answered some questions that were related to your age, your retirement year, your income, and your expected Social Security income. We've also taken into account your tax bracket. Through a combination of all these things, we can make some projections and get a pretty good idea of what not only your Social Security income will be in retirement, but show what that looks like compared to what your healthcare costs will be. What you'll see here is when you combine your Part B and D premiums and the upcharges, according to IRMA, when you add on top of that your dental and vision, and when you add a Medigap plan, which you'll see here in yellow, we get the total cost of your healthcare in this chart. Now in this example, you'll see at age 86, this individual stopped getting their Social Security. And that's not just because Social Security decided I'm not going to pay, it's because the amount that they were paying for their medical costs has gotten so high that it eats up their entire Social Security check. So you're looking at income that people rely on, yet with the increasing costs of healthcare, you don't even need to be that far into retirement for a lot of you before you start seeing all of that Social Security income being eaten up by healthcare expenses alone.
So you're probably asking yourself, why hasn't anybody shown me this? If they haven't shown you this, please comment in the section below and give us your thoughts.
One of the big frustrations that we hear pretty often from clients is that they've had financial advisors, they've done a great job of planning for retirement, and all of a sudden there's this big piece of the puzzle. And for some, the biggest piece of the puzzle, and it's been missing, and nobody's informed them. That's because most financial advisors don't have expertise in Medicare or in healthcare. And so it's something that they might use averages, they might skim over, but we rarely see where people are prepared to the extent that they should be for what they'll pay in healthcare costs.
Let's now take a look at the table. So you'll see that there's a table that's highlighted, says projected taxes and healthcare costs in 5-year increments. Let's walk through that just so you can get a clearer understanding of really what that table is saying. The first thing, when you filled out the quiz, you gave us an idea of what your estimated Social Security income would be. In this example, it's $2,000 a month to start. We use the historical average to come up with a yearly increase for Social Security, and you'll see that in the columns past 70 and 75. We then assumed a tax on Social Security of 85% of your benefit. So basically what that means is that if you make over a certain amount of income, you have to pay tax on 85% of your Social Security benefit. So again, in this example, that would be $1,700 that you would be taxed on of the $2,000 benefit. So that figure, Social Security income tax, is using an income tax rate using your estimated income in the quiz. Then we look at the Part B and D premium, so that takes into account the IRMA, or the punch in the gut tax, so what those numbers look like. We then add other healthcare costs, including Medigap and dental and vision expenses, to come up with a total monthly healthcare cost in this example of $751. We then net it out to come up with Social Security. So we can see in this example, the person was earning $2,000 to start with. When they actually factored all these costs in, they ended up with $700. When you get your Social Security statement, or if you go online and look at your Social Security statement, there's a little line that basically Social Security has added. It changes from year to year, but this year it essentially said that by 2035, Social Security won't have enough money to pay full benefits. They'll only be able to pay 77 cents on the dollar. Now, this is the government saying it, it's not us. It does change, as we said, but again, reflects the situation of the baby boomers coming into both Medicare and Social Security. If you take that number and assume that the government's telling us the truth on this, then you'll see that that individual is only going to be earning $260 from their Social Security check. And then over the years, it begins to go away to where at some point in time, they're literally writing a check to the government.
And in this case, they have less than 10 years of retirement where they're even receiving money from the Social Security Administration. Page 3 is, for the most part, self-explanatory, but what we really want you to understand is that what we've shown you on page 2 is not necessarily the full picture when it comes to healthcare costs. So what we've done is we've taken the same information that we use to calculate your healthcare costs, and we have come up with projections for what your long-term care costs will likely be in retirement. And just as a refresher, long-term care is what's defined as care, whether it's a nursing home, skilled nursing facility, home health care, assisted living, the types of things that many people think that they might need when they're older, but it could also be due to an accident, dementia, Alzheimer's. There can be many different reasons that people need long-term care, but the reality is 60% of Americans will at some point in their lives need long-term care, and long-term care is not covered by Medicare. So when you're taking your health into consideration and all the costs that are associated with what you might need, long-term care really is a big piece of the puzzle for a lot of people. The costs are extremely high for long-term care, and they've just gotten higher and higher. So as you can see in the example that we're showing you right now, we estimate that this person, who's actually 59,
it's about 120,000 if they had somebody that would come into their house to take care of them, and over 238,000 if they were in a nursing home.
And this is a pretty conservative approach that we've taken because we're only looking at 1 year of long-term care. I think the average is 2 for most Americans that need it.
For women it's close to 3, and for men it's a little over 1.5. So, but those are averages. Obviously, if you're in a nursing home because of dementia or a cognitive impairment, those stays can be much longer. But this is really designed just to give you an idea of how to plan for that. The fourth page of the report really is about what can you do to help mitigate some of these costs. The first thing you have to understand is that you want your healthcare costs to be paid on a tax-free basis. That does 2 things. Number one, obviously it doesn't subject that income to taxes where you're having to pay more dollars, but also it can lower your modified adjusted gross income, which is the trigger that the government uses to define what you're going to pay for that punch in the gut tax, the IRMA, means testing, whatever you want to call it. They really base it off of your modified adjusted gross income. So you'll see at the top here, the best plans are those that are tax deductible while you're working, tax deferred while you're working, and tax free when you take them out. Most of you have probably heard of a health savings account. You may or may not have the ability to save in one, but those are great plans that you can use for retirement that when you take the money out for healthcare will be tax free. A couple of lesser known plans are VIBAs, which are a lot of governments offer those to their employees. So if you're a government employee and you have access to that type of a plan, you should be thinking about contributing to it. And then some defined benefit cash balance plans, which are really retirement plans offered by companies and governments, have what we call 401h accounts. Those 401h accounts may have money in them that can be used to pay for healthcare costs tax-free. So those tend to be the 3 best to start with. And then some of the other accounts that are not quite as good because they're not tax deductible on the front end, but are Roth accounts. So that could be 401k, 403bs, 457s. And essentially how those work is you don't get a tax deduction when you're contributing, but they do grow tax deferred, and you can take the money out tax-free after 59 and a half. So, so that's one option. A couple of other options are there are some annuity payments that you would receive. An annuity is an investment vehicle that will pay you an income when you're retired. Typically, it's guaranteed for your life. And some of that income, depending on how it's structured, may be tax-free and not taxable to you. So another way to look at it. Some life insurance products, if they're properly structured, can throw off tax-free income to you to pay for these costs.
And there are a number of different things that you can do as an individual, but we also just want to give you another little hint here, and that's that the most efficient way to prepare for these costs is to work with your employer. So if you're in a position where you can talk with your HR department or with your employer about different ways that they can help you prepare for healthcare and retirement, there are tax efficient, beneficial ways for both parties to do that. So if it's something that you're thinking about, if it's something that might be an option for you, feel free to apply to become our client in the description below, or you can leave a comment if you want to ask more questions.
Yeah, well said, Shannon. The employer policies, especially when we talk about long-term care, most employers can actually pay for long-term care premiums for their employees, and the employee doesn't have to report that as income, and the employer can tax deduct it. Great benefit that they can be providing to their employees.
So if you want to become a client and plan for the future, now that you know you need to, again, feel free to click the link below and apply to become our client. And you also actually have a link on the last page of your report where you can visit our masterclass that gives you a little bit more information, and will also guide you to the application to become our client.